Forecasting is crucial when you raise capital, and it's key when running the business. Missing your numbers can not only cost you your job, but can also lead to the total loss of your business. In this episode, we will cover the top 5 forecasting methods and strategies for the SaaS business. During my time in private equity and venture capital, we were spending a lot of time with the founders on their budget and their financial forecasts. As a founder of a holding company with an award-winning B2B SaaS marketing agency, I deal a lot with questions on forecasting. We build growth models for clients with detailed channel segmentation and customer acquisition costs for each. Intro. What's up, everybody? Welcome to my channel. I'm Alexej, an entrepreneur and investor, and I drop an episode once a week with insights from companies we work with. If you're excited to dive into the first strategy, go ahead and press that like button for the YouTube algorithm. A lot of my content in this channel has been about growing your SaaS business and raising capital for your startup. The topic of forecasting is probably the elephant in the room though. If you cannot forecast well, you won't be able to raise capital, and if your forecasting is off and you spend too much money on the wrong channels too quickly, your founder career might be over faster than you thought. Now, let's kick off the top 5 forecasting methods for the SaaS industry. And we start with the method number 1, sales capacity and modeling your funnel. This strategy aligns sales teams' capacity with funnel stages to optimize lead management and conversion. Tailoring marketing to match sales capabilities ensures high-quality leads are efficiently nurtured, crucial for scalable growth. In terms of best practice, leveraging technology for dynamic forecasting models allows SaaS companies to adjust their sales strategies in real time, optimizing lead management and conversion rates. That's possible with HubSpot, for example. The SaaS platform DevStream specializes in developer tools, implemented sales capacity planning alongside funnel modeling to identify that the most significant bottlenecks were at the demo stage. By reallocating resources to provide more personalized demos, they saw a 25% increase in conversion rates within 3 months. Efficiency is doing better than what is already being done. A quote by Peter Drucker. Now, the second strategy is the predictive analytics summary. Predictive analytics uses data to forecast customer behavior and churn, enabling proactive product and marketing decisions. It transforms data into actionable insights, reducing churn and opening new revenue avenues. A common mistake, though, is underestimating costs, particularly those associated with customer acquisition and retention. And that can significantly impact the profitability and accuracy of predictive analytics, making it crucial to factor these expenses into forecasting efforts. An example is FitTrack, a health and wellness SaaS offering personalized fitness plans, utilizing predictive analytics to identify at-risk customers who were likely to churn based on engagement metrics. By intervening with customized workout recommendations, they reduced churn by 15% quarter over quarter. Now, a famous quote here by Geoffrey Moore is, "Without big data analytics, companies are blind and deaf, wandering out onto the web like deer in a freeway." Now, if you learned something from that video already, and if you're still watching this, please leave a yes in the comment section below. Now, the third forecasting method is account by account and pipeline. This approach treats each account uniquely, customizing engagement to increase conversion and satisfaction. Prioritizing high-value prospects and personalizing sales tactics boost retention and customer lifetime value. EduTech Solutions, a SaaS company providing learning and management systems, adopted an account-by-account approach to better serve their diverse clientele, ranging from small private schools to large universities. By tailoring their sales and support efforts, they were able to increase their customer lifetime value by 40%. Seth Godin, renowned marketing and growth expert, mentioned treat different customers differently, and that's why you have different forecasting methods as well. The account by account and pipeline forecast approach underscores the shift from one-size-fits-all strategy to a more nuanced, customer-centric model, crucial for winning in today's competitive SaaS landscape. If you want to learn more about forecasting in the B2B SaaS world, check out the SaaS Minds podcast, link below. Every week, I'm interviewing founders with at least $1 million in ARR on how they grew their business. It's fascinating to see how many different founders use different forecasting methods. But now, back to our top 5 list, which covers, of course, all of them quite briefly. Now, on position number 4, we have customer lifetime value forecasting. Customer lifetime value forecasting, CLV, predicts the revenue from customer relationships, guiding resource allocation to profitable segments. It helps in focusing on high-value customers, enhancing satisfaction, loyalty, and long-term growth. Considering economic trends and competitive landscape changes in this forecasting method are vital, enabling businesses to accurately identify and invest in the most profitable customer segment. An example is GreenGrow, a SaaS platform for sustainable agriculture management. They implemented CLV forecasting to prioritize their marketing efforts towards organic farms, which had a 30% higher CLV compared to conventional farms. This strategic focus led to a more efficient allocation of the marketing budget and significantly increased the customer acquisition. The purpose of a business is to create a customer who creates a customer. Shift saying. Now, before I cover my last forecasting method in SaaS, please hit that like button. So, last but not least, on position number 5, cohort-based approach forecasting. The cohort-based approach segments customers to analyze behavior and interactions over time, offering insights into churn and lifetime value. This strategy is key for SaaS companies, allowing tailored strategies for product, marketing, and services to drive growth. An example is BookNook, a SaaS startup offering an online book club platform which used a cohort-based approach to analyze its user behavior over time. They discovered that users who participate in at least 2 book clubs within their first month had a 70% higher retention rate. This insight led them to revamp their onboarding process to encourage new users to join multiple clubs early on. An additional insight is that a cohort-based approach offers a granular view of customer behavior, providing a roadmap for continuous improvement and innovation in product offerings and customer experience. Feeling more confident in forecasting or need more help? If you need a hand setting up forecasting and growth models, book a call with us and we can help review your traffic sources and figure out how to allocate your budget across channels and across the future months, quarters, and years. NUOPTIMA is one of the leading B2B SaaS growth agencies out there. We work with companies backed by YC, Sequoia, Carlyle, Lightspeed Ventures, Northzone, and many other top investors. I drop an episode once a week with insights from companies we work with, venture-backed, private equity-owned, or bootstrapped SaaS businesses all around the world. If you have a fellow founder, if you have a team member, if you're part of a Slack group, Telegram, or WhatsApp group with other founders that could get value from this video, please share it with them. Finally, please hit that subscribe button and that bell icon so you'll get notified every single time I release an episode. I want to help as many people as possible to scale a business. Thank you for joining me on this journey. I'm Alexej and I will see you in the next episode.